Hello and welcome to the second video within the key metrics section where we're going to talk about effective gross income. Where we left off was talking about gross potential rent. Now, gross potential rent, as a refresher, is the maximum amount of rent you believe your property can generate within 1 year, if it's fully occupied at current market rates. Now, effective gross income is how much revenue you believe this property will actually receive at the end of those 12 months. So we need to create some loss factors to account for the reasons that you may not collect 100% of the rent. The first thing that we need to do is we need to factor in a small amount of vacancy. If you think about a single family property that you are going to rent, if you have to turn that property over between tenants, you have to paint, you have to clean the carpets, you may have to fix a couple of appliances or light fixtures, etc. That may take a week, that may take 2 weeks. If it's 2 weeks, your vacancy factor for that property is going to be almost 4%. That's a big deal. And you need to factor that into your analysis because there will be vacancy in the property at some point. It may not be in the first year, but it might be in the second, third, or fourth year. And it may not be 4%, it may be a lot worse than that. So you need to figure out what the vacancy rate is in your property type, in your market, and you need to factor in a vacancy allowance so that you're not surprised when you do have a vacancy because it's bound to happen eventually. The next thing we need to factor in are concessions. Concessions are enticements to get people to rent in your property. And in certain markets, concessions are standard practice. So you need to determine what the market delivers to potential tenants and what you're going to have to deliver to your potential tenants to get them into your property. That's especially the case if your property is somewhat inferior to the competition. So you want to know what the competition is doing so that will better give you an understanding of what you need to do. The last thing you want to back out is bad debt. Especially if you're doing rental apartments, you're going to have people that don't pay 100% of their rent 100% of the time. People get in car accidents, they have medical emergencies, it happens all the time, and they don't pay their rent. And it's really hard to evict them, and it's really hard to collect. So you're going to want to have a small bad debt collection. People bounce checks, there's a myriad of reasons that it happens, so you're going to want to have an allocation for that as well. The last thing you want to do is you want to add back in other income. So other income is going to be pet fees, it's going to be parking, it's going to be maybe you have coin-operated machines in the basement and you collect the coins out of that. Now, all of this is separate from the rent because it's not guaranteed like the rent is. Maybe the pet passes away and the pet fee goes away, or they sell their car so they no longer need to pay for parking. This is month-to-month income that comes and goes. So you want to add it back in, but you also want to be conservative. You don't want to assume that it's just going to keep going up, because that's never the case. Look at the historical other income, and that's going to give you a really good gauge of where it should be in the future. One other note about the total loss allowance you want to factor in. If your property is 100% occupied from day one, your total loss allocation should be somewhere between 2 and 5% of gross potential income. That's the way the bank's going to look at it. And if you don't look at it that way from the beginning, then you're going to have a big fight with your bank. They're going to think the property's worth less than you. So you want to factor that in from day one in your analysis so you find a really good property. You should also stress all of these things by 2, 3, 4, 5% so that you see how bad it could get. And you want to see how that affects your cash flow at the end of the day and make sure you can still pay your debt service so that you don't end up in default with your loan. But ultimately, that's it. So in the next video, we're going to talk about operating expenses, and there's a lot to cover. So we'll see you in the next video.